Okay, guys, we had a couple headlines in the multifamily and office space that blew my mind. If you think it's just about vacancy or about low performing properties, wait until you hear this story about multifamily. It will blow your mind. These are profitable and increasing in profit properties that are defaulting. I'm going to show you what's happening. Let's get into it. First things first is the BizNow article. 9 out of 10 maturing office CMBS loans defaulted in September. Now, really important to note that we don't know what's happening to loans outside of CMBS. It's not to say that we can't see some filings and things, but CMBS is especially public because these are mortgage-backed securities that have been separated and then sold to the public. So it's in my 401k. I don't know if it's in your 401k, but it's in my 401k. You say, Ethan, why would you still own this stuff in your 401k? Well, I'm fixing to change that. According to the article, 88.9% of CMBS loans associated with office properties defaulted at their maturity in September. Now we're going to talk, this is very interesting because this is different than extension. In fact, what was interesting about this was that from the beginning of the year through September 30th, outcomes for maturing CMBS office loans had been more varied, with only 34% defaulting, which is insanely high, and 34.7% being modified or extended, and 31% being paid off. Now, why that's important is because it went from 34% defaulting and 34% modified or extension. I don't know if you've heard the term extend and pretend, but for a long time, for this year, that's been kind of the thought, is maybe that they'll just get extended and pretend like everything's okay. Well, it appears that things are changing drastically with 88.9% defaulting. Now, this isn't the most important thing to me in this article. It's actually what happened in multifamily. Now, multifamily payoffs dropped sharply in September, according to the Moody's article. Well, let's just go to the Moody's article and see exactly what they were saying, because my jaw dropped when I saw this. But in fact, let's just read a couple of the bullets really quick. The first is maturing office loan payoff for September comes in at 11%. That just sounds so different. Maturing loan payoff comes in at 11%. I laughed when I read that because keep in mind, that's the exact same as this. 9 out of 10 maturing office CMBS loans defaulted. Okay? Such funny. I mean, I just think it's comical spin, right? Okay. Multifamily payoff rate plunged in September from 94% to 78% for the month, dropping year-to-date rate to 90%. Okay, let me say that again. Multifamily payoff rate plunged in September from 94 to 78%. Now, that is concerning. Alarm bells should be going off, but then they kind of nuance it. They dug into this number. So let's go to where they dug into this number. It's very good. They had 2 really, really good charts. The first chart they have is year-to-date payoff rate by major property types. And you can see multifamily has been crushing it compared to everything but industrial, right? Industrial is apparently the place to be, but outside of industrial, multifamily has been fantastic. And especially if you're in, because it's been so good, if you're in the right areas of multifamily, it can be fantastic. People love it. Rent growth has been strong in certain markets, and now that's starting to crumble a little bit. But what makes this fascinating, what makes this jaw-dropping, why I am so shocked about this, let's go to the next. This is by month for multifamily, and you can see September was just dramatically different. So they dug into why the monthly payoff rate was so bad in September. And here's what they found. They found that some of it was low-income housing tax credit. So some of this was low-income multifamily. That was 25% of the non-payment. So what about the other 75%? This is the one that absolutely caught my eye. 20% of the loan balance that failed to pay off was tied to 2 loans in student housing in Gainesville, Florida. What makes this so shocking, and believe me guys, you should be shocked by this, is that the NOI, the net operating income for the first half of 2023, was on track to increase nearly 50%. The net operating income was drastically increasing. Despite the strong increase, the property has a large loan that resulted in a debt yield of 8%. And while that would have been more than enough to secure free financing 2 years ago, it falls into a more questionable range in today's market, and the loan appears to have been granted a 60-day extension, so we'll keep an eye on it. Guys, They couldn't make their payment, not because income wasn't increasing, not because they weren't performing on all their metrics. Net operating income over the loan amount, you would get 8%. That's a strong number for really what interest rates were for the past several years. And yet now we're seeing that would not get you, a refi. There's nobody that's willing to offer debt apparently at that price, at least for now. Now that is fascinating to me because I think this will happen more and more. In fact, if you know who Hyman Minsky is, he writes about this in an increasing rate environment. That's where your entities, your companies, your commercial real estate, anything that's leveraged, slowly the dominoes start falling, and we're starting to see the dominoes fall outside of office, which was an obvious disaster. Okay, office was a disaster because nobody's returning to office. What makes multifamily so eye-popping is that income is increasing, but there are multifamilies out there that are unable to pay their debt. That is where we should all take a step back and say, okay, let's keep an eye on this. That's major, major red flag. So if you found this helpful, please click like, and hope you guys have a great day.